Welcome back to Simple Mind Space, your go-to podcast for mastering your money and your mind. Today, we're diving deep into a topic that often carries a negative connotation, but when understood correctly, can be a powerful tool for building wealth. Yes, you guessed it, we're talking about debt. Now, you might have heard the saying, debt is slavery. To a certain extent, that's true. Drowning in high-interest debt can feel suffocating, limiting your choices and keeping you trapped in a cycle of repayment. The numbers are certainly daunting. Total U.S. consumer debt is a staggering $15 trillion, averaging over $5,300 per household. But here's the good news. Not all debt is created equal. While credit card debt, car loans, and even student loans often carry high interest rates and feel like burdens, there's another side to the debt coin, a side that the wealthy use strategically to build their empires. Today, we're going to unravel the mystery of how the rich use debt to get richer. We'll expose the tactics they employ and demystify the financial instruments they leverage to make debt work in their favor. Let's get started. Leveraging trade debt, a global game changer. Imagine this. You've identified a hot product, let's say eco-friendly, reusable water bottles. You know there's a growing market for them, and you're eager to capitalize on the trend. But you're also aware that sourcing, manufacturing, and shipping a large inventory requires a significant upfront investment. This is where the power of trade debt comes into play. Over the past few decades, China has emerged as the world's manufacturing powerhouse, producing a vast array of goods at competitive prices. To facilitate smoother transactions, many factories are open to loaning their products to businesses, essentially offering them credit. Instead of paying for the entire inventory up front, you can negotiate terms with the factory, agreeing to pay for the goods once you've sold them. This allows you to start your business without tying up your own capital. Essentially, you're saying to the factory, I believe in this product and I know how to sell it. Let me share my expertise with you. If I can sell it at a profit, we both win. This model has fueled global trade for decades, and it's a prime example of how debt, when used strategically, can be a win-win situation. Refinancing real estate debt, unlocking hidden profits. Real estate has long been hailed as a wealth-building vehicle, and for good reason. But did you know that savvy investors rarely pay for properties in full? Instead, they leverage the power of mortgages and refinancing to maximize their returns and minimize their tax burdens. Let's say you've saved up $200,000 and are eyeing a fixer-upper property listed at $500,000. You secure an 80% mortgage, putting down $100,000 and borrowing the remaining $400,000. You then invest $50,000 in renovations, transforming the property into a desirable rental unit. Now, here's where the magic of refinancing happens. After the renovations, the property's market value has increased to $700,000. You approach your bank for refinancing, and this time, you're eligible for a larger loan based on the improved value. Let's say 80% of $700, which equals $560,000. Of this new loan amount, $400,000 goes towards paying off your initial mortgage, and you've already spent $50,000 on renovations. This leaves you with a profit of $110,000, $560,000, and $400,000 of $50,000. You've effectively used debt to increase your property's value, generate rental income, and pocket a tidy profit, all while benefiting from mortgage interest tax deductions. Hedge funds and the art of short selling, capitalizing on declines. Hedge funds, often shrouded in an aura of mystery, are investment funds primarily accessible to high net worth individuals and institutions. While individual investors typically aim to profit from rising stock prices, hedge funds often employ a contrarian strategy known as short selling, profiting when a company's stock price declines. Imagine you have a hunch that a particular social media company's stock price is headed for a downturn. You believe that new privacy regulations will negatively impact their business model. You could short sell their stock by borrowing shares from your broker and immediately selling them on the open market. Let's say you borrow and sell one share at $100. If your prediction is correct and the stock price drops to $70, you can buy back one share at the lower price and return it to your broker, pocketing the $30 difference as profit. While short selling can be highly lucrative, it's essential to remember that it carries significant risk. If your prediction is wrong and the stock price rises, your potential losses are theoretically unlimited. However, for sophisticated investors with deep pockets and access to extensive research and analytics, short selling remains a powerful tool. Forex trading on margin, amplifying profits and risks. The foreign exchange market, or FOREX, is the global marketplace where currencies are traded. Its vastness and 24/7 accessibility make it an attractive arena for investors seeking to capitalize on currency fluctuations. One of the unique aspects of Forex trading is the ability to trade on margin, essentially borrowing money from your broker to leverage your trades. This allows you to control larger positions with a smaller initial investment, amplifying both profits and losses. For example, with a 100-to-1 leverage ratio, for every $1,000 you deposit into your trading account, you can control a position worth $100,000. This means that even a small movement in your favor can result in significant gains. However, it's crucial to remember that leverage is a double-edged sword. While it can significantly magnify profits, it can also amplify losses, potentially exceeding your initial investment. Therefore, Forex trading on margin requires a deep understanding of the market, risk management strategies, and a disciplined approach. The power of a stellar credit score, unlocking lower interest rates. Remember how we mentioned that not all debt is created equal? Well, one of the key factors that determines the goodness or badness of debt is the interest rate, and your credit score plays a pivotal role in securing favorable interest rates. Think of your credit score as your financial report card. It's a numerical representation of your creditworthiness, reflecting your history of borrowing and repaying debts responsibly. The higher your credit score, the more attractive you are to lenders. Why does this matter? Because a higher credit score opens doors to lower interest rates on mortgages, car loans, and even business loans. This translates to substantial savings over the life of the loan. For example, a difference of just 1% in interest rates on a $300,000 30-year mortgage can amount to tens of thousands of dollars in interest payments over the loan term. By cultivating responsible financial habits, such as paying your bills on time, keeping your credit card utilization low, and maintaining a healthy mix of credit, you can build a strong credit score and unlock access to lower-cost debt, saving you money in the long run. Key takeaways: mastering the art of good debt. As we've explored in this episode, debt can be both a powerful tool for building wealth and a slippery slope leading to financial distress. The key lies in understanding the difference between good debt and bad debt, and leveraging debt strategically to your advantage. Here are the key takeaways. Not all debt is bad. Strategic use of debt, such as trade credit, mortgages, and even certain types of business loans, can be powerful tools for wealth creation. Refinancing can unlock hidden profits. By refinancing your mortgage after increasing your property's value, you can access equity, generate passive income, and reduce your tax burden. Short selling and Forex trading offer high-risk, high-reward opportunities. These advanced investing strategies can be profitable, but require deep knowledge, risk tolerance, and a disciplined approach. Your credit score is your financial passport. A high credit score opens doors to lower interest rates, saving you money on loans and increasing your borrowing power. Remember, knowledge is power. By understanding the nuances of debt, you can make informed financial decisions, leverage debt strategically, and pave your path towards financial freedom. Thank you for joining us on this episode of Simple Mind Space. If you found this episode valuable, we encourage you to like, share, and subscribe to our channel. And don't forget to hit that notification bell so you never miss an update. Until next time, keep learning, growing, and mastering your money and your mind.